Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. An indecisive spinning top yesterday and a limited, very limited follow-on lower to the previous session's very interesting key reversal down. The one point that was interesting really about yesterday was the close back below the congestion zone between 103.38 to 103.69, as well as a second consecutive close again below the long moving average, currently 103.64. However, I should point out that the close was only just below the congestion area. Overall, the market is still getting gently squeezed in between the overhead, seemingly still influential upper tine, currently at 104.58, and the support of the upper trend line, currently 102.29, of the September to date ascending wedge pattern. This also still leaves the way open to look at the action since mid-November as a possible double top. I wish to highlight once again the two recent core patterns seen here since late September. A September to end of November ascending triangle, and a September to date ascending wedge pattern, currently at 98.38 to 102.29. Now, I've highlighted the ascending wedge pattern in blue to show you a clearer idea of what I am talking about. In early November, we saw a clear break above the upper trend line of the ascending wedge pattern. This left us with some topside opportunities. We've already reached and exceeded the primary and secondary targets for the ascending triangle pattern, so these have been retired. We still have live, though, the possible targets for the ascending wedge pattern of a primary target X2 in the 105.35 area and a secondary harder to reach target X3 in the 107.65 area. However, the broken upper tine's capping action with the long moving average and the congestion sitting in the middle of what's going on, well, as I've said the last few days, this cannot go on much longer, as the upper trend line and the broken upper tine meet at an apex by late December, so watch out. So far today, well, a reactionary move back up over the descending long moving average and right through the congestion between 103.38 and 103.69, but having trouble sustaining that move. Cable, aka sterling against the US dollar. An indecisive doji cross yesterday, almost, but not quite, a gravestone doji. All in all, it was not really a follow-on lower to the previous two bearish black crows. In reality, I suspect it was more a reactionary move due to the approaching upper trend line, currently 118.83 of the September to date ascending wedge pattern. The market now seems to be getting slowly squished between the upper trend line below and the now flatlining long moving average above, currently at 121.46, plus the early May low at 121.54. Overall, I'm still mindful that the move up late last week still managed to reach target X at 120.20. This was the primary target for the late September to late November ascending triangle. As I've repeated here often, much as in Eurodollar, there are two core patterns at work here. I've highlighted the relevant trend lines in blue to help visualize what is going on. We have a late September to late November ascending trend line, a triangle, which has run its course, and also a September to date ascending wedge pattern, currently 115.89 to 118.83. Both patterns have been previously compromised and both have repaired themselves. Late 3 weeks ago, there was a break higher over the flat trend line of the ascending triangle, giving us the previously achieved primary target X in the 120.20 area and the secondary harder to reach target X1 in the 122.50 area. More recently, we've had a consecutive closes over the upper trend line of the ascending wedge pattern, leading to a primary target X2 for this pattern in the 124.20 area and a secondary hard to reach target X3 in the 128 even area. Of the three remaining targets above, we now have to wait and see what the market will do as it gets squeezed in between the previously declining long moving average above and the rising upper trend line below. Now, so far today, a reactionary move back up, I suppose somewhat unsurprisingly, but we haven't really gone that far, not even up to the old, well, we've only just managed, I suppose, the old 120.20 target, X, though we are set up for a possible bullish engulfing pattern just with that, which isn't the hardest thing to do, I suppose, considering yesterday was an indecisive doji cross. Euro sterling. An indecisive spinning top yesterday, which I suppose is aspirations to be a hanging man pattern, but not quite making it. Prices started and finished up sitting on top of the slowly rising medium moving average, currently at 86.23, after a dip down to the old target X at 86.02. This was the primary target for the recently highlighted roof pattern constructed during November and picked out in blue on my daily chart. Meanwhile, the top side failed to even test the April 2020 low at 86.69 and didn't even think about trying the lesser Fibonacci level at 86.98. That was the base of the roof pattern. All this has left us with the secondary hard to reach, much harder to reach if I'm honest, target X1 below in the 85.45 zone. Interestingly, I have decided to keep for the moment the broken, since repaired, and now broken again, lower time, currently at 87.37 of the April to August bullish Andrews pitchfork on my daily chart. I'm going to keep a close eye on this lower time just in case. And I'd also like to point out that there is no finessing of this bullish Andrews pitchfork into a shallower bullish shift pitchfork. This is not possible here. Once it is finally done, it will be wholly retired. So far today, well, not much. A tentative move to the medium moving average below and the April 2020 low above. Though prices have pushed down below the medium moving average, though they're not sustained the move lower, and we're looking like an indecisive spinning top right now. US dollar against the Indian rupee. Another interesting piece of action yesterday. A lower open that eventually became a bullish opening white Mariposa, and also a day 2 in a 2-day bullish meeting lines pattern. Once again, the close is on the lesser Fibonacci line at 81.63, with the rising short medium moving average pushing up over it from below, currently at 81.71. This time the market did not try up to the recent congestion at 81.94. But just beyond that, the next congestion is a small band between 82.15 to 82.26. I'd now like to discuss the larger scenario, one which I'd often mentioned in my earlier commentaries. So I've highlighted the September to early November ascending expanding wedge pattern. You can see that in blue on my daily chart. In early November, prices pushed down through the lower trend line and carried on down until 2 weeks ago. This process confirmed the pattern and gave a primary target in the 80.90 zone and a secondary harder to reach target X1 in the 80.28 zone. In mid-November, the market reached the primary target, but we've since seen a market bounce up from the rising medium moving average below, currently 80.74, such that I am now wondering if perhaps, just perhaps, reaching the primary target may have been enough. This requires a little more contemplation and some further data over the next few sessions. In the meantime, I've also drawn a fresh September to mid-November bullish Andrews pitchfork, highlighted in purple on my daily chart. The market is at this moment penetrating the lower time, currently 81.52. I've also today drawn a shallower bullish shift pitchfork in case I have to retire the Andrews pitchfork. The market is at the moment in between the lower time below, currently at 80.89, and the middle time above, currently 82.56. If this becomes more significant, I will obviously highlight it in another color. So far today, what is looking like a combined bearish engulfing pattern and bearish opening black Mariposa, with the most significant feature being the break today below the lower time of the bullish Andrews pitchfork. The next support is the recent 50% Fibonacci line at 81.13 before the ascending lower time of the bullish shift pitchfork. US dollar against the Brazilian real. A very interesting bearish open and close along black Mariposa yesterday, and second bearish black crow. Now prices managed to punch down through the broken upper time, currently at 534.98 of the July to late August bearish shift pitchfork, and finished in that very fine, very narrow space on top of the slowly rising short medium moving average, currently at 526.93, and just below what I have repeatedly have said is not that good a support, and that's the 50% Fibonacci line, the May 2020 to April 22 move, 527.37. All that is pretty interesting on its own, but what I alluded to earlier is that this move down has now set up this week to be a weekly key reversal. Thus, if we close on Friday, either below 538.25, that's 538.25, or above 541 even, then we'll be on. Anything in between make it a lesser outside week. And this ties in with another point I've repeatedly highlighted. We are already set to make a monthly key reversal for November. If we close tonight, that's tonight, either over 541.54 or under 517.91, then we'd be on. Right now we are looking at the lesser cousin to the monthly key reversal, an outside month. Now, in the immediate vicinity, just below the short medium moving average, we have the 50% Fibonacci line at 522.76, the March 21 to April 2022 move. I've often said that this looked a better support. However, I suspect the strength was due to the recent conglomeration of moving averages nearby, which are now dispersing, and thus it is losing its joint efficacy. Below that, we have the lesser Fibonacci line at 520.27, and then the middle time, currently 511.96 of the broken bearish shift pitchfork. US dollar against the Mexican peso. A possible, very large hammer pattern yesterday, though it was also a third bearish black crow. The market dropped down through the mid-November low at 1935.40 and through the March 2020 low at 1915.05 before seemingly running out of steam in the mid-1903s and reverting back upwards. But not enough to wholly seal the damage that has been done that day, though it did have a good try with the hammer pattern. I've previously highlighted the combined overhead cap of the declining short moving average, currently at 1938.78, and the upper time, currently 1943.29, of the broken but still influential March to July bearish Andrews pitchfork. Together, they have contributed to the bearish pressure and the failure last Friday to close over the May low at 1940.70, despite piercing it. Overall, the recent moves lower all relate to the previously highlighted crossover combination of back in late October, of the broken upper tine of the March to July bearish Andrews pitchfork and the middle tine, currently in 1970.94, of the still intact bearish shift pitchfork for the same move. I've highlighted this pitchfork in blue on my daily chart to help you visualize, as a visual aid to help in visualizing it. The question now is, what's next? Well, it all depends if the market follows this large hammer construction from yesterday, or it continues to follow the bearish pressure from the broken upper tine. If it follows the latter, well, then the lower tine, currently at 1881.45, highlighted in dark blue, of the bearish shift pitchfork may well come into play. Now, so far today, a reactionary move back up, but not by that much, though it still looks like a bullish harami, if only just right now. Thank you for listening. This short version broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.